Hello, and welcome to a guide to U.S. federal tax relief programs. Who qualifies? My name is Ayman Mahmood, and I will be your guide through this series. Over the next 15 chapters, our goal is to demystify the world of federal tax relief, providing you with a clear and comprehensive understanding of the options available to U.S. taxpayers. Before we begin, it is essential to state that the information provided in this series is for educational and informational purposes only. We are not providing financial, legal, or tax advice. The tax code is complex and an individual's situation is unique. Therefore, you should always consult with a qualified and licensed professional, such as a certified public accountant, CPA, or a tax attorney, for advice tailored to your specific circumstances. This series is designed to be a starting point for your own research and a resource to help you ask the right questions when you seek professional guidance. So let's begin with the fundamental question. What exactly is federal tax relief? For millions of Americans, receiving a notice from the Internal Revenue Service, or IRS, can be a source of significant stress and anxiety. This is especially true when that notice indicates a balance is due, a tax debt. This situation is far more common than many people realize. Tax debt can happen for a variety of reasons: a sudden change in employment, unexpected freelance or side gig income, a mistake on a past tax return, or significant life events like a divorce or a medical emergency that impacts your finances. When faced with a tax liability that you cannot immediately pay, it's easy to feel overwhelmed and uncertain about what to do next. This is precisely where the concept of federal tax relief comes into play. In simple terms, federal tax relief refers to the various programs and provisions established by the IRS to help taxpayers who are unable to pay their tax debt in full and on time. It's a common misconception that the IRS is an immovable force solely focused on collection. In reality, the IRS has a structured system designed to work with taxpayers. Their primary goal is to encourage voluntary compliance, and they recognize that financial hardship is a genuine issue. These relief programs are the tools the IRS uses to achieve that goal, providing pathways for taxpayers to manage their debt and get back into good standing. It's crucial to understand that tax relief is not about tax evasion or ignoring your obligations. Tax evasion is illegal. Tax relief, on the other hand, involves legally available solutions sanctioned by U.S. tax law. Think of it as a set of safety nets. These programs are designed to find a workable solution that allows the taxpayer to resolve their debt without suffering undue financial hardship. The landscape of tax relief can generally be broken down into three broad categories, which we will explore in great detail in later chapters. First, there are options that give you more time to pay. If you acknowledge the debt is accurate and you have the ability to pay it over time, the IRS offers solutions like payment plans. This is one of the most common forms of relief and allows you to make manageable monthly payments until the debt is settled. Second, there are programs that may allow you to settle your tax debt for less than the full amount you owe. This is typically reserved for taxpayers experiencing significant financial difficulty. The most well-known program in this category is the Offer in Compromise, or OIC. Qualifying for this type of relief involves a detailed review of your financial situation, including your income, expenses, assets, and ability to pay. And third, there are provisions for those who simply cannot afford to pay at all right now. In certain circumstances, the IRS can designate an account as currently not collectible. This doesn't make the debt disappear, but it temporarily pauses collection efforts until the taxpayer's financial situation improves. Throughout this series, we will break down each of these categories. We'll discuss what each program is, how it generally works, and the typical eligibility requirements the IRS looks for. We will cover installment agreements, offers in compromise, penalty abatement, currently not collectible status, innocent spouse relief, and more. Our objective is to arm you with knowledge. By understanding the terminology and the purpose behind these programs, you can have more informed conversations with a tax professional and better understand the options they present to you. Navigating a tax issue can feel like trying to find your way through a dense forest without a map. Consider this series your compass and your map. It will show you the possible paths, explain the terrain, and help you identify the landmarks along the way. In our next chapter, we will take a closer look at the very first steps you should consider when you realize you have a tax debt, focusing on how to communicate with the IRS and understand the notices they send. Thank you for joining me for this introduction. I look forward to guiding you through the next chapter. Welcome back to a guide to U.S. federal tax relief programs. In our last chapter, we introduced the concept of federal tax relief and established that the IRS has systems in place to help taxpayers manage their debt. Today, we're going to discuss the critical first steps to take when you realize you owe the IRS. This often begins with a piece of mail, an official IRS notice. As always, please remember that the information in this chapter is for educational purposes only and does not constitute legal or financial advice. Always consult a licensed tax professional for guidance on your specific situation. The moment you see that IRS envelope in your mailbox, it's natural to feel a sense of dread. Your first instinct might be to set it aside, hoping the problem will somehow resolve itself. This is the single most important instinct to fight. Ignoring communication from the IRS is the one action that can almost guarantee a small problem will become a much larger one. The reason is simple: penalties and interest. When you have an unpaid tax balance, the IRS is required by law to charge interest on the outstanding amount. In addition, they may assess penalties, such as the failure to pay penalty. These charges accumulate over time, causing your total debt to grow. Responding promptly shows the IRS that you are not ignoring your obligation, and opens the door to a potential resolution before things escalate. So the first rule is, don't panic, but also don't ignore it. Once you've opened the letter, the next step is to understand what you're looking at. IRS notices can seem confusing, but they follow a specific format and are generated for specific reasons. The most important piece of information is often located in the top right-hand corner: the notice number. This code, typically a combination of letters and numbers like CP14 or LT11, tells you and the IRS the exact purpose of the letter. Let's briefly touch upon a few general categories of notices you might encounter. First is the basic balance due notice. A very common example is the CP14, Notice of Tax Due and Demand for Payment. This is typically the first notice sent to a taxpayer when they have a balance due. It will state the amount of tax owed, any penalties and interest calculated so far, and a deadline for payment. It is a straightforward notification. Second is a notice proposing changes to your tax return. The CP2000 is a frequent notice in this category. This notice is not a bill or an audit. It means the income and/or payment information the IRS has on file from third parties, like your employer, on a W-2, or a bank, on a 1099, doesn't match the information you reported on your tax return. The CP2000 will show the proposed changes and calculate the additional tax that would be owed if those changes are correct. It gives you a specific deadline to respond, either by agreeing with the changes or by disagreeing and providing documentation to support your original return. Third, there are the more serious collection notices. If earlier notices are not addressed, the IRS will begin a more assertive collection process. A notice like the CP504, Final Notice of Intent to Levy and Notice of Your Right to a Hearing, is a final warning. It states that the IRS has the legal right to seize or levy your property if the debt isn't resolved. This can include garnishing your wages, taking money from your bank account, or seizing assets like your car or home. Receiving this notice is a clear sign that immediate action is required. Regardless of the specific notice you receive, your initial action plan should follow a few logical steps. Step 1. Read the notice carefully. Read the entire document from start to finish. Make sure you understand the tax year in question, the amount the IRS believes you owe, and most importantly, the deadline for your response. Step 2. Review your records. Compare the information in the notice to your own copy of your tax return for that year. Was there a simple error? Did you forget to report some income? Or do you believe the IRS is mistaken? Gathering your own documents is a critical step before you formulate a response. Step 3. Decide how to respond. You generally have 3 paths. If you agree with the notice, your next step is to figure out how to pay. If you can pay the full amount by the deadline, that is the simplest solution. If you cannot, you will need to explore the payment options we will discuss in our next chapter. If you disagree with the notice, you must respond in writing by the deadline, explaining why you disagree and providing copies of any documents that support your position. Never send original documents. Step 4. Contact a professional. If you feel confused by the notice, if the amount owed is substantial, or if you plan to dispute the IRS's findings, this is the ideal time to seek professional help. A tax professional can help you interpret the notice, communicate with the IRS on your behalf, and ensure you meet all deadlines. In our next chapter, we will begin exploring the solutions available to those who agree they owe the tax but cannot pay it all at once. We will start with the most common form of tax relief, the IRS installment agreement. Thank you for listening. Welcome back. In our last chapter, we discussed the crucial first steps after receiving an IRS notice. Don't ignore it, understand it, and respond in a timely manner. Now we'll dive into the first major category of tax relief solutions: programs that give you more time to pay. For many taxpayers, the primary issue isn't a dispute over the amount owed, but rather a lack of funds to pay the entire balance at once. The single most common solution for this is the IRS installment agreement. As we proceed, please keep in mind this information is for educational purposes. An installment agreement has legal implications, and you should always consider consulting with a qualified tax professional to understand how it applies to your personal financial situation. So, what is an installment agreement? At its core, it is a formal payment plan arranged with the IRS. It allows you to make regular monthly payments for a specified period until your tax debt, including any accrued penalties and interest, is paid in full. Think of it like a loan repayment plan. It's a structured way to resolve your debt over time, preventing the IRS from escalating to more serious collection actions, such as a wage garnishment or a bank levy, as long as you adhere to the terms. It's very important to understand a key fact about these agreements. Interest and penalties do not stop accumulating. While an approved installment agreement is in effect, the IRS will reduce the failure to pay penalty rate, often by half. However, interest continues to compound daily on your outstanding balance. This means the longer your payment plan, the more you will ultimately pay. The goal is always to pay the debt as quickly as your finances reasonably allow. The IRS offers several types of payment plans, but they generally fall into two main categories: short-term and long-term. A short-term payment plan gives you up to 180 additional days to pay your tax liability in full. This option is beneficial if you just need a few months to get the funds together, perhaps while waiting for a bonus or a commission check. There are generally no setup fees for this type of plan, although interest and penalties still apply. Individuals who owe less than $100,000 in combined tax, penalties, and interest can often request this type of extension. A long-term payment plan, which is what most people refer to as an installment agreement, is for those who need more than 180 days. These plans can extend for up to 72 months, or 6 years. To qualify for what the IRS calls a streamlined installment agreement, which has a faster approval process, individuals generally must owe $50,000 or less in combined tax, penalties, and interest. Additionally, you must have filed all of your required tax returns to be considered eligible. If your debt is above this threshold, a payment plan may still be possible, but the IRS will typically require more detailed financial information, and the process is more complex. How does a taxpayer typically set up an installment agreement? For those who meet the streamlined criteria, the process is quite straightforward. The IRS has an online payment agreement, or OPA, tool on its website, irs.gov. This allows eligible taxpayers to apply for a payment plan in a matter of minutes, without ever needing to speak to an agent. You will need to provide some personal information to verify your identity, and suggest a monthly payment amount. The system will then let you know if your proposed plan is accepted. For taxpayers who prefer not to use the online tool, or who do not qualify for it, an agreement can also be requested by phone, by mail using Form 9465, Installment Agreement Request, or through a tax professional. There are setup fees associated with long-term installment agreements. The fees vary depending on how you apply. Online is the least expensive, and how you choose to make your payments. Setting up a direct debit from your bank account not only results in a lower setup fee, but also helps ensure you never miss a payment, which is critical. If you miss payments, you risk defaulting on your agreement, which could lead to the IRS resuming collection actions. In our next chapter, we will discuss another important tool for taxpayers: penalty abatement. We will explore the circumstances under which the IRS might agree to remove or reduce the penalties assessed on your tax debt. Thank you for listening. Welcome back to our guide on U.S. federal tax relief. In the last chapter, we explored the IRS installment agreement, a tool that gives you more time to pay your tax debt. Today, we are going to focus on a different aspect of that debt: the penalties. Penalties can significantly increase the total amount you owe, but in certain situations, the IRS may be willing to reduce or even eliminate them through a process called penalty abatement. As a reminder, this series provides general educational information. The rules surrounding penalties are complex, and eligibility for abatement is determined on a case-by-case basis. You should always discuss your specific circumstances with a licensed tax professional. First, let's clarify what a penalty is. When you don't comply with tax laws, the IRS can assess penalties on top of the actual tax you owe. The most common penalties for individuals are the failure to file penalty, for not filing your tax return by the due date, and the failure to pay penalty, for not paying the tax you owe on time. There can also be accuracy-related penalties if you substantially understate your tax liability. It is critical to understand that penalty abatement does not cancel your underlying tax debt. You are still responsible for paying the actual tax you owe. Abatement only applies to the additional penalty charges that have been added to your account. However, since penalties can sometimes be as much as 25% of your unpaid tax, having them removed can provide substantial financial relief. The IRS doesn't grant penalty relief without a valid reason. There are 3 primary grounds under which the IRS will consider abating a penalty. The first, and perhaps most widely used, is the First-Time Penalty Abatement Administrative Waiver. This is often called the FTA for short. As the name suggests, this relief is available to taxpayers who have a clean compliance history. Generally, to qualify, you must meet 3 key criteria. Filing compliance. You must have filed all currently required tax returns or filed a valid extension. Payment compliance. You must have paid or arranged to pay any tax due. This means you could be in an active installment agreement and still qualify. Clean penalty history. You must not have had any penalties of the same type assessed on your account for the 3 tax years prior to the year you are requesting abatement for. If you meet these conditions, the IRS may remove the failure to file, failure to pay, and failure to deposit penalties for a single tax period as a one-time courtesy. The second major reason for abatement is showing reasonable cause. This is for situations where you were unable to meet your tax obligations due to circumstances beyond your control, despite exercising ordinary business care and prudence. Unlike the first-time abatement, reasonable cause is not based on a clean history, but on the specific facts and circumstances of your case. What does the IRS consider reasonable cause? There isn't a simple checklist, but common examples include a death or serious illness of the taxpayer or an immediate family member, an unavoidable absence, the destruction of your home or business records due to a fire, flood, or other natural disaster, inability to obtain necessary records. Simply forgetting the deadline, or not having enough money to pay the tax, is generally not considered reasonable cause by itself. When you make a request based on these grounds, you must provide a detailed explanation, and often need to supply supporting documentation, such as hospital records or insurance reports, to substantiate your claim. Finally, there are statutory exceptions, which are specific exceptions written into the tax code. A common example is receiving incorrect written advice directly from the IRS, which led to the penalty. Requesting penalty abatement is typically done by calling the IRS for a first-time abatement request, or by sending a written explanation. For more complex cases involving reasonable cause, a tax professional will often submit a formal letter or use Form 843, Claim for Refund and Request for Abatement. In our next chapter, we will discuss a more significant form of relief for those in severe financial distress: the Offer in Compromise, a program that may allow you to settle your tax debt for less than the full amount. Thank you for listening. Hello and welcome back. In our previous chapters, we've discussed getting more time to pay your tax debt and having penalties removed. Today, we're moving into a much more significant form of tax relief, one that is often misunderstood: the Offer in Compromise, or OIC. This is a program that may allow certain taxpayers to resolve their federal tax liability with the IRS for a lower amount than what they originally owed. Before we dive in, it is critically important to repeat our standing advisory. This information is for educational purposes only. The Offer in Compromise program is complex, with strict legal and financial requirements. Seeking guidance from a qualified tax professional is essential before pursuing this option. An offer in compromise is a formal agreement between a taxpayer and the IRS. It is not a program for everyone. The IRS will only consider an OIC under specific circumstances where there is a legitimate doubt that the full tax liability can ever be collected. It is designed for individuals and businesses facing true, significant financial hardship. There are a few grounds for an OIC, but the most common by far is called doubt as to collectability. This means that based on a taxpayer's complete financial picture, their assets, income, and expenses, it is highly unlikely that the IRS will be able to collect the full amount owed before the time limit for collection expires. The collection statute is typically 10 years from the date of assessment. To be considered for an OIC, a taxpayer must first meet some basic eligibility requirements. You must have filed all required tax returns and be current with any quarterly estimated tax payments or federal tax deposits for the current year. You also cannot be in an open bankruptcy proceeding. The core of the OIC evaluation process revolves around a key concept: the reasonable collection potential, or RCP. This is the mathematical formula the IRS uses to determine the minimum amount they will accept in an offer. It is not an arbitrary number. The RCP is calculated by looking at two main components. First, the net realizable value of your assets. This includes things like cash and bank accounts, investments, vehicles, and real estate. The IRS will look at the equity in these assets, meaning the asset's fair market value minus any loans against it. Second, your future remaining income. The IRS calculates your average monthly income and subtracts your necessary living expenses. The standards for what the IRS considers a necessary expense are quite strict and are based on national and local averages. Any remaining monthly income is then multiplied by a set number of months into the future to arrive at a total. The combination of your asset equity and your future remaining income becomes your reasonable collection potential. In nearly all cases, your offer amount must be equal to or greater than your RCP for the IRS to even consider it. The application process itself is rigorous. It requires submitting a detailed application package, which includes Form 656, Offer in Compromise, and a comprehensive financial statement, Form 433A for individuals or 433B for businesses. You must provide extensive documentation to back up the numbers on your financial statement, including bank statements, pay stubs, vehicle registrations, and property records. There is also a non-refundable application fee and, in most cases, an initial non-refundable payment that must be submitted with the offer. These amounts are only waived for taxpayers who meet specific low-income certification guidelines. The IRS thoroughly investigates every OIC application. If they find that you have the ability to pay the full debt either in a lump sum or through an installment agreement, your offer will be rejected. This is why the program is often seen as a last resort for those who truly have no other way to resolve their tax debt. In our next chapter, we will discuss what happens when your financial situation is so severe that you cannot afford to pay anything at all right now. We will explore the IRS's currently not collectible status. Thank you for listening. Welcome back to our ongoing guide to U.S. federal tax relief. In our last chapter, we examined the Offer in Compromise, a complex program for settling tax debt for less than the full amount. Today, we address an even more fundamental question. What happens when your financial situation is so difficult that you cannot afford to pay anything at all toward your tax debt? This is where the IRS may place your account into what is known as currently not collectible, or CNC status. As we explore this topic, please remember that this is for informational and educational use only. A determination of CNC status is based on a detailed analysis of your finances, and you should seek advice from a qualified tax professional to understand your options. So, what exactly does currently not collectible mean? It is crucial to understand that CNC status is not a form of debt forgiveness. It does not eliminate your tax debt. Instead, it is a temporary suspension of active collection efforts from the IRS. If the IRS determines that you are unable to pay your basic living expenses, let alone your tax bill, they can place your account in CNC status. This means they will temporarily stop actions like sending levies to your bank or garnishing your wages. However, and this is a critical point, your debt continues to grow while you are in CNC status. Interest and penalties will still be added to your account balance, just as they would be with an installment agreement. CNC is a temporary pause button, not a stop button. Qualification for CNC status is based on a standard of financial hardship. The IRS will conduct a thorough review of your income, expenses, and assets. To do this, they will typically require you to complete a collection information statement, such as Form 433F or 433A. The IRS will compare your monthly income to a set of allowable living expenses. These standards are based on national and local data for things like housing, food, transportation, and healthcare. If your documented necessary expenses are equal to or greater than your income, leaving no disposable income to make any payments, the IRS may grant you CNC status. It is not a status you can simply ask for without providing proof. The IRS must be convinced that forcing you to pay would leave you unable to provide for your basic needs. What can you expect while your account is in CNC status? First, as mentioned, the aggressive collection actions will cease. This can provide immense relief and breathing room for someone in a difficult financial spot. However, the IRS will likely still file a notice of federal tax lien if one is not already in place. A tax lien is a public notice of the government's legal claim against your property for the amount of your tax debt. This can negatively impact your credit and make it difficult to sell assets or secure loans. The IRS will also periodically review your situation. Typically, every 1 to 2 years, Their automated systems will check the income reported on your annual tax return. If your income increases to a point where you now have the ability to make payments, the IRS will remove the CNC status and contact you to arrange a payment solution, such as an installment agreement. Finally, every tax debt has a legal deadline for collection, known as the Collection Statute Expiration Date, or CSED. This is generally 10 years from the date the tax was assessed. If a taxpayer's account remains in CNC status for the entire duration of this period, and the CSED is reached, the tax liability is extinguished by law. This is not a strategy, but rather a legal outcome for those who experience prolonged financial hardship. In our next chapter, we will shift our focus to a very specific type of relief designed for individuals who have tax problems stemming from a joint return filed with a current or former spouse. Innocent spouse relief. Thank you for listening. Welcome back. In the first part of our series, we covered the major tax relief programs that apply broadly to many taxpayers. We now begin to explore more specialized forms of relief designed for very specific circumstances. Today, we'll discuss the provisions known collectively as innocent spouse relief. As always, this information is for educational purposes. The rules surrounding joint tax returns and liability are deeply rooted in law, and these relief provisions are highly dependent on individual facts and circumstances. Consulting with a tax professional who specializes in this area is strongly recommended. To understand the solution, we must first understand the problem. When a married couple chooses to file their federal income tax return jointly, they both agree to what is known as joint and several liability. This is a critical legal concept. It means that each spouse is legally responsible for 100% of the tax, penalties, and interest due on that return, even if they later divorce. The IRS can collect the entire debt from either spouse, regardless of who earned the income or who made the mistake that resulted in the tax debt. This can create an incredibly unfair situation. For example, one spouse might hide income or claim improper deductions without the other spouse's knowledge. Years later, often after a separation or divorce, the unsuspecting spouse could be held responsible for the entire tax bill. Innocent spouse relief provisions were created to address these exact situations. Innocent spouse relief is actually an umbrella term that covers three distinct types of relief a person can request. The first is traditional innocent spouse relief. To qualify for this, a taxpayer generally must show that they filed a joint return which has an understatement of tax. The understatement is due to erroneous items of their spouse or former spouse. They can prove that at the time they signed the return, they did not know, and had no reason to know about the error. And finally, that taking into account all the facts and circumstances, it would be unfair to hold them liable for the tax. Reason to know is a key factor here. The IRS will consider your level of education, your involvement in the family's finances, and whether there were any lavish or unusual expenditures. The second type is separation of liability relief. This provision allows for the allocation, or division, of the tax debt from a joint return between the two spouses. If granted, you would only be responsible for the portion of the tax debt allocated to you. This relief is generally only available to taxpayers who are no longer married, are legally separated, or have not lived in the same household for at least 12 months. The third type is equitable relief. This is a more flexible, catch-all category. It may be granted if you do not qualify for the other two types of relief, but it would still be unfair, or inequitable, to hold you responsible for the tax debt. The IRS considers many factors, including whether you are experiencing economic hardship, whether you received a significant benefit from the unpaid tax, and in some cases, whether there was spousal abuse or financial control exerted by the other spouse. Equitable relief is the only one of the three that can apply to an underpayment of tax. That is, tax that was reported correctly but never paid. A taxpayer requests these forms of relief by filing Form 8857, Request for Innocent Spouse Relief, with the IRS, usually within 2 years from the date the IRS first began collection activities against them. In our next chapter, we will discuss the formal process for disagreeing with an IRS decision, a crucial topic known as the IRS appeals process. Thank you for listening. Welcome back to a guide to U.S. federal tax relief programs. So far, we have explored various programs the IRS offers to help taxpayers. But what happens if you apply for one of these programs, like an offer in compromise or penalty abatement, and the IRS denies your request? This is where another crucial aspect of the taxpayer rights system comes into play: the right to appeal. This chapter provides a general overview of the IRS appeals process.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
This is a procedural topic with legal elements, so it is essential to remember this is for educational purposes only. If you find yourself in a position where you need to dispute an IRS decision, consulting with a qualified tax professional is a critical step. Within the IRS, there is an independent organization known as the Office of Appeals. The mission of appeals is to help taxpayers and the government resolve their tax disagreements without having to go to court. Think of it as a form of mediation. The appeals office is separate from the IRS examination or collection divisions that made the initial decision on your case. This independence allows them to take a fresh, impartial look at the facts and the law. The goal of an appeals conference is to reach a settlement that is fair and reasonable to both the taxpayer and the government. Appeals officers have the authority to consider factors that the initial IRS employee may not have been able to, such as the hazards of litigation, meaning the potential for either side to lose if the case were to be taken to tax court. You generally have the right to appeal most IRS decisions. Some common situations where a taxpayer might file an appeal include the rejection of an offer in compromise, the denial of a request for penalty abatement based on reasonable cause, the denial of an innocent spouse relief claim, a disagreement with the results of an IRS audit, where the IRS proposes additional tax, a notice of intent to file a federal tax lien, or a notice of intent to levy your property. In most of these cases, the IRS will send you a letter. This letter will explain the IRS's position and inform you of your right to appeal. It will also specify a deadline by which you must request an appeal, which is often 30 days. The process for requesting an appeal typically begins by filing a formal, written document called a protest. This is not simply a letter of complaint. A formal protest is a detailed document that must explain your disagreement, present the facts of your case, and cite any laws or authorities that support your position. It must be signed under penalties of perjury. Once a valid protest is received, your case is transferred to the Office of Appeals and assigned to an appeals officer. This officer will review your case file and your protest. They will then schedule a conference, which today is often held by telephone or through correspondence. During this conference, you or your representative will have the opportunity to present your arguments and evidence. The appeals officer will present the government's side, and the goal is to find a middle ground. If you reach an agreement, you will sign a closing form, and the case will be resolved. If you cannot reach an agreement, the appeals office will issue a formal notice of deficiency, which gives you 90 days to file a petition with the U.S. tax court. The appeals process is a valuable right, providing a cost-effective and efficient way to resolve disputes. In our next chapter, we will take a closer look at one of the IRS's most powerful collection tools, which we have mentioned several times, the Notice of Federal Tax Lien. Thank you for listening. Welcome back to our guide. In the last chapter, we explored the IRS appeals process, a taxpayer's right when they disagree with an IRS decision. Today, we're shifting our focus back to the collection process and examining one of the most significant tools the IRS uses to secure a tax debt, the Notice of Federal Tax Lien. This topic involves legal claims and can have serious financial consequences. As always, the information provided here is for educational purposes only, and you should seek advice from a qualified tax professional regarding your specific situation. So what is a federal tax lien? A lien is a legal claim by the government against your property to secure payment of a tax debt. The lien itself actually arises automatically and secretly by law as soon as three things happen. The IRS assesses your tax liability. They send you a bill called a notice and demand for payment, and you neglect or refuse to fully pay the debt in time. What most people are familiar with is the Notice of Federal Tax Lien. This is a public document, typically filed with the county records office, that alerts the world, including creditors, banks, and potential lenders, that the government has a legal claim against all your property. The notice serves to protect the government's interest in your assets. It is absolutely essential to understand the difference between a lien and a levy. These two terms are often confused, but they mean very different things. A lien is a claim. It secures the debt by attaching to your property. It's like putting a public sticker on everything you own that says, the IRS has first rights to this property if it's sold. It doesn't, by itself, take the property away from you. A levy, on the other hand, is an action. A levy is the actual seizure of your property to satisfy the tax debt. When the IRS takes money from your bank account or garnishes your wages, that is a levy. The general progression is that a lien comes first to secure the government's interest, and if the tax debt remains unpaid, a levy may follow to actually collect the debt. We will discuss levies in detail in our next chapter. A filed notice of federal tax lien can have severe and lasting consequences. First, it can be devastating to your credit. The lien is reported to credit bureaus and can drastically lower your credit score, making it very difficult to get a loan, a mortgage, or even a credit card. Second, the lien attaches to all of your assets. This includes your home, your car, your bank accounts, and any other real or personal property you own. It also attaches to any property you acquire in the future while the lien is still in effect. Third, it complicates selling property. If you sell your home, for example, the tax lien must be paid off out of the proceeds before the title can be transferred to the new owner. If there isn't enough equity to pay both the mortgage and the lien, it can make a sale nearly impossible without negotiating with the IRS. So how is a tax lien removed? The most straightforward way to get a lien released is to pay the tax debt in full. Once the debt is satisfied, the IRS will issue a certificate of release of federal tax lien within 30 days. Other options include having the debt settled through a successful offer and compromise, or having the statute of limitations on collections expire. In some specific situations, a taxpayer might be able to apply for a withdrawal of the lien notice, which removes the public notice as if it were never filed, even if the debt is still being paid through an installment agreement. These procedures are complex and have specific requirements. In our next chapter, we will discuss the next step in the collection process, the IRS levy. Thank you for listening. Welcome back. In our last chapter, we made a critical distinction between a tax lien and a tax levy. We learned that a lien is a legal claim the government places on your property to secure a tax debt. Today, we will discuss the much more direct and impactful collection action that can follow a lien, the IRS levy. As we delve into this serious topic, it is essential to reiterate that this content is for educational purposes only. A levy is a legal seizure of property, and if you are facing this action, you should immediately seek assistance from a qualified and licensed tax professional. So what is a levy? While a lien is a claim, a levy is the IRS's method of actually taking your property to satisfy a tax debt. It is a seizure. This is one of the most powerful tools the IRS has for collecting unpaid taxes, and they do not use it lightly. The IRS cannot simply decide to levy your assets out of the blue. By law, they must follow a specific procedure that provides you with notice and an opportunity to resolve the debt. This process generally includes 3 steps. The IRS assesses the tax and sends you a notice and demand for payment. You neglect or refuse to pay the tax. The IRS sends you a final notice of intent to levy and notice of your right to a hearing. This is a critical document, typically sent by certified mail. It must be sent at least 30 days before the levy can take place. This notice informs you of your right to request a collection due process, or CDP, hearing, which is a formal appeal that we will discuss in a future chapter. If you do not respond to this final notice by either paying the debt, setting up a payment arrangement, or requesting a hearing within the 30-day period, the IRS is then legally free to begin seizing your assets. What kind of property can the IRS levy? The answer is broad, almost anything of value. One of the most common forms of levy is a wage garnishment. In this case, the IRS sends a notice to your employer, who is then legally required to withhold a significant portion of your wages and send it directly to the IRS. This is a continuous levy, meaning it stays in effect, taking money from every paycheck until the debt is paid or the levy is released. Another common target is your bank account. A bank levy is a one-time seizure. The notice freezes the funds in your account on the day the bank receives it, up to the amount of your tax debt. The bank holds these funds for 21 days before sending them to the IRS. This 21-day period gives you a final, brief window to contact the IRS and try to get the levy released, usually by proving severe economic hardship or making other arrangements to pay. The IRS can also levy federal payments, such as a portion of your Social Security benefits. In more extreme cases, they can seize physical assets like your car, your house, or other property, although this is less common for the average taxpayer. It's important to know that the law does provide some protections. Certain types of property and a certain amount of your income are exempt from levy. For example, the IRS cannot take unemployment benefits, certain public assistance payments, or necessary personal effects and school books. For wage garnishments, a portion of your income is legally protected based on your filing status and number of dependents, to ensure you have enough for basic living expenses. The key takeaway is that a levy is the result of a collection process that has escalated due to unresolved tax debt. The notices the IRS sends beforehand are your opportunities to prevent it from happening. In our next chapter, we will discuss the taxpayer's most important protection against a levy: the collection due process hearing. Thank you for listening. Welcome back. In our last chapter, we discussed the serious nature of an IRS levy, which is the actual seizure of property. We mentioned that before a levy can occur, the IRS must provide you with a final notice of intent to levy and inform you of your right to a hearing. Today, we will explore that right in detail. It is one of the most important taxpayer protections available: the collection due process, or CDP hearing. This chapter covers a formal legal process. The information is for educational purposes only. The CDP process has strict deadlines and legal implications, and navigating it correctly often requires the assistance of a qualified tax professional. A collection due process hearing is your formal opportunity to appeal a proposed IRS collection action before it takes place. It is a right guaranteed by law. You can request a CDP hearing after you receive one of two specific notices: a final notice of intent to levy and notice of your right to a hearing, or a notice of federal tax lien filing and your right to a hearing. The request for this hearing must be made in writing, typically using Form 12153, Request for a Collection Due Process or equivalent hearing. Most importantly, your request must be postmarked within 30 days of the date printed on the IRS notice. This is a strict, non-negotiable deadline. The power of a timely CDP request cannot be overstated. Once you file a valid request, the IRS is legally prohibited from proceeding with the levy action until the hearing is concluded and any subsequent court appeal is finished. This provides a critical pause, giving you time to resolve the underlying issue without the immediate threat of having your assets seized. The hearing itself is conducted by the independent IRS Office of Appeals, the same body we discussed in Chapter 8. This ensures that your case is reviewed by an impartial officer who was not involved in the original decision to pursue collection. During the hearing, you have the right to raise any relevant issue related to the proposed collection action. This can include: first, you can propose collection alternatives. This is the most common use of a CDP hearing. You can present evidence that you should be considered for an installment agreement, an offer in compromise, or currently not collectible status. Second, you can challenge the appropriateness of the collection action. You can argue that the proposed levy is more intrusive than necessary to resolve the debt. Third, in very limited circumstances, you can dispute the amount of the tax you actually owe. You can only do this if you did not receive a prior opportunity to dispute it, such as during an audit or by going to tax court earlier in the process. After the hearing, the appeals officer will review all the evidence and arguments from both you and the IRS Collection Division. They will then issue a written notice of determination that explains their decision. If you agree with the determination, you will proceed with the agreed-upon solution. If you disagree, the notice of determination gives you another powerful right: the right to challenge the appeals office's decision by filing a petition in the U.S. tax court. This ability to seek judicial review is a cornerstone of the CDP process, providing a final layer of oversight. In summary, the CDP hearing is not just a meeting. It is a fundamental right that stops collection action in its tracks and ensures an independent review of your case. In our next chapter, we will introduce another resource for taxpayers: the Taxpayer Advocate Service. Thank you for listening. Welcome back. Throughout this series, we have navigated some of the complex, formal processes for dealing with tax issues, including hearings and appeals. But what if you are facing a problem and the normal IRS channels just aren't working? What if you feel like you are stuck in a bureaucratic loop? For these situations, Congress created an independent organization inside the IRS to be your voice: the Taxpayer Advocate Service, or TAS. As always, this information is for educational purposes. TAS is a specific resource for certain situations, and this chapter will provide a general overview of its role and function. The Taxpayer Advocate Service is a unique organization. Although it is part of the IRS, it operates independently and reports directly to Congress through the National Taxpayer Advocate. Its mission is twofold. First, and most directly for individuals, it provides free help to taxpayers who are facing significant hardship as a result of an IRS action, or who are unable to resolve their problems through normal channels. Second, it works to identify systemic issues within the IRS and recommend changes to prevent future problems for all taxpayers. Think of TAS as a safety net. It's not meant to replace the standard ways of communicating with the IRS, but it is there for cases where those standard methods have failed, and the taxpayer is suffering as a result. Not every taxpayer with a problem qualifies for TAS assistance. The service is designed for those who need it most. You may be eligible for TAS help if your case meets one of several criteria. The most common ones include: you are experiencing a significant hardship. This can be an economic burden, such as being unable to provide basic necessities like food or housing. For example, if the IRS has levied your bank account and you now cannot pay your rent, that is a significant hardship. You are facing an immediate threat of adverse action. This is for urgent cases where, for instance, a levy is scheduled to happen in the next few days. You have tried to resolve an issue with the IRS through normal channels, but you have received no response or an inadequate response by the promised date. An IRS system or procedure is not working as it should. For example, a computer error is repeatedly generating incorrect notices, and you have been unable to stop it. So, what can TAS actually do for a taxpayer? A TAS case advocate acts as your guide and representative within the IRS. They can help you navigate the complex internal bureaucracy to get your problem resolved. They have the authority to cut through red tape and can issue something called a Taxpayer Assistance Order, or TO. A TO can legally compel the IRS to take a certain action, to expedite a process, or to cease an action, such as releasing a levy that is causing a significant hardship. To request help, a taxpayer can call their local TAS office. There is at least one in every state, or they can file Form 911, Request for Taxpayer Advocate Service Assistance. Again, it is important to remember that this service is completely free. In our next chapter, we will discuss a critical concept that underlies every tax issue: the statute of limitations. Thank you for listening. Welcome back to our guide. In the last chapter, we discussed the Taxpayer Advocate Service, a key resource for resolving complex issues. Today, we are going to explore a foundational concept that governs nearly every tax matter: the statute of limitations. These are the legal time limits that establish the period during which the IRS can take action, and the period during which you, the taxpayer, can claim a refund. This is a legal topic with many exceptions and complexities. The information presented here is a general overview for educational purposes. You must consult with a tax professional to understand how these timelines apply to your specific facts and circumstances. Think of statutes of limitations as the official timelines for the tax system. They provide finality for both the taxpayer and the government. There isn't just one timeline. There are three primary statutes of limitations that every taxpayer should be aware of. First is the statute of limitations on assessment. This is the time limit the IRS has to audit your return and assess any additional tax. For most situations, the IRS has 3 years from the date you filed your tax return. If you filed before the April due date, the clock starts on the due date. However, there are important exceptions. If a taxpayer substantially understates their gross income by more than 25%, the statute extends to 6 years. And in cases of a fraudulent return or a failure to file a return at all, there is no statute of limitations, meaning the IRS can assess tax at any time. Second is the statute of limitations on collection. We have mentioned this before. It is often called the CSED, or Collection Statute Expiration Date. This is the time limit the IRS has to collect a tax after it has been assessed. The general rule is that the IRS has 10 years from the date of the tax assessment. This 10-year clock is crucial. If the IRS does not collect the debt within this period, the liability is legally extinguished. It's important to note that certain actions, such as filing for an offer in compromise, requesting a collection due process hearing, or filing for bankruptcy, can pause or toll the 10-year clock. Third is the statute of limitations on refunds. This timeline works in the taxpayer's favor. It is the deadline you have to file a claim for a credit or refund that you are entitled to. To claim a refund, you must generally file a claim, usually by filing an amended return on Form 1040-X, within 3 years from the date you filed your original return or 2 years from the date you paid the tax, whichever is later. If you never filed a return for a year where you were due a refund, you typically have 3 years from the original due date of that return to file it and claim your money. After that deadline passes, the refund is forfeited to the U.S. Treasury. Understanding these three timelines is fundamental to navigating any tax issue. They determine how long you need to keep your tax records, when you can be confident a tax year is closed, and how long you have to claim money that is rightfully yours. In our next chapter, we will look at a specific and serious issue that applies to business owners and those responsible for payroll taxes: the trust fund recovery penalty. Thank you for listening. Welcome back. For most of this series, our focus has been on individual income tax issues. In this chapter, however, we are turning our attention to a critical and often perilous topic for business owners, corporate officers, and anyone with financial authority in a company: payroll taxes and the Trust Fund Recovery Penalty, or TFRP. This is one of the most serious penalties the IRS can impose. The information here is a general, educational overview. If you are a business owner or are involved in business finances, it is essential to understand these rules and to consult with a tax professional for guidance. To understand the penalty, we first need to understand the concept of trust fund taxes. When a business has employees, it is required to withhold certain taxes from their paychecks. These include federal income tax and the employee's share of Social Security and Medicare taxes. This withheld money does not belong to the business. The business is merely acting as a custodian, holding this money in trust for the U.S. government. The business's legal obligation is to remit these funds to the IRS on a timely basis. The trust fund recovery penalty comes into play when a business fails to pay these trust fund taxes over to the government. The TFRP allows the IRS to hold the individuals who were in control of the business's finances personally liable for the unpaid amount. This is the most critical aspect of the TFRP. It transfers the business's debt to an individual's personal finances. It effectively pierces the corporate veil. Even if your business is a corporation or an LLC, which normally protects you from business debts, this penalty makes you personally responsible. The penalty amount is 100% of the unpaid trust fund taxes. So who can the IRS hold responsible? The law states that the penalty can be assessed against any responsible person who willfully failed to pay the taxes. A responsible person is not just the owner or CEO. It is anyone who had significant authority and control over the company's finances. The IRS looks at factors like who had the authority to sign checks, who decided which bills and creditors to pay, who was in charge of filing and paying payroll taxes. This could be a corporate officer, a bookkeeper, or even an employee with significant financial discretion. The second requirement is that the failure to pay must have been willful. This term can be misleading. It does not require a criminal or evil intent. In the context of the TFRP, willfulness simply means that the responsible person knew the taxes were due, or recklessly disregarded the fact that they were due, and consciously chose to pay other creditors instead. This is a common scenario for a struggling business. A responsible person might choose to pay a critical supplier, the landlord, or even the company's own net payroll to keep the doors open, intending to catch up on the IRS payments later. In the eyes of the law, that intentional decision to pay other bills before the government constitutes a willful failure to pay the trust fund taxes. If the IRS determines that an individual was a responsible person who acted willfully, they will propose the TFRP assessment against that individual personally. The IRS can then use its full range of collection tools, including personal liens and levies, to collect the debt. In our final chapter, we will discuss how to take the next step: choosing a qualified tax professional to help you. Thank you for listening. Welcome to the final chapter of a guide to U.S. federal tax relief programs. Over the last 14 chapters, we have traveled through the complex landscape of federal tax issues. We've defined what tax relief is, explored options from installment agreements to offers in compromise, and discussed your fundamental rights as a taxpayer, from the appeals process to the Taxpayer Advocate Service. Our goal has been to replace uncertainty with knowledge. In this concluding chapter, we will discuss the most critical step in putting that knowledge to use: how to find and choose a qualified professional to help you. The information in this series is your map, but a good tax professional is your experience guide. As always, this information is for educational purposes. We are not endorsing any specific individual or company. Why is professional help so important? While this series has armed you with information, a qualified professional provides 3 invaluable assets: expertise, experience, and representation. They understand the nuances of the tax code that we could only touch upon. They have experience negotiating with the IRS and know what arguments and documentation are most effective. Most importantly, they can represent you. By signing a power of attorney, you authorize them to speak to the IRS on your behalf, lifting a tremendous weight of stress and anxiety from your shoulders. There are 3 main types of professionals who have unlimited representation rights before the IRS, meaning they can represent you on any tax matter. Enrolled agents, EAs. These professionals are licensed directly by the IRS. They must pass a comprehensive 3-part examination covering all aspects of taxation. Because their license comes from the federal government, an EA can represent taxpayers in any state. They are specialists purely in taxation. Certified public accountants, CPAs. CPAs are licensed by their respective state boards of accountancy. They have passed a rigorous exam and have met extensive education and experience requirements. While CPAs have broad expertise in accounting and finance, many specialize in taxation. Tax attorneys. These are lawyers who are licensed by their state bar. They specialize in tax law and are the only professionals who can represent you in U.S. tax court if your case needs to be litigated. They are essential for complex legal disputes, criminal tax issues, or challenging an appeals decision in court. Just as important as knowing who to hire is knowing who to avoid. The tax relief industry unfortunately has some players who use deceptive practices. Be cautious of these red flags. Guarantees of a specific outcome. No one can guarantee they will settle your tax debt for pennies on the dollar before thoroughly analyzing your entire financial situation. Large upfront fees. Be wary of anyone who asks for thousands of dollars before they have even reviewed your case or spoken to the IRS. Lack of clear credentials. Ask directly. Are you an enrolled agent, a CPA, or a tax attorney? If they are not, their ability to represent you is severely limited. High-pressure sales tactics. A reputable professional will give you time to make an informed decision. To find a professional, you can use the IRS's own online directory of credentialed preparers. You can also check your state CPA society or bar association. Always schedule a consultation, ask about their experience with cases like yours, and get a clear understanding of their fees in writing. This concludes our guide. We hope this series has empowered you with the knowledge and confidence to face your tax issues head-on. Remember, while a tax problem can be stressful, there are legal, structured pathways to resolution, and there are qualified professionals ready to help you navigate them. Thank you for listening.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.